When you think of a successful company, what's the first thing that pops into your head? For most of us, it's profit, right? Revenue, earnings, all those numbers that shout about how well the company is performing. But what if I told you the world's most famous investor thinks you're starting in completely the wrong place? Yeah, let's get into that. And there it is, straight from the man himself. I mean, just let that sink in for a second. It's so counterintuitive. It flies in the face of how most people analyze a business. He doesn't start with the splashy headlines about recent profits. Nope, he starts with the balance sheet. And that's the billion-dollar question, isn't it? If the income statement is where you see all the money a company's making, why on earth would Buffett spend most of his time on what a lot of people think of as the boring statement? The answer to this really gets to the absolute core of his entire investing philosophy. See, it all boils down to one simple thing: understanding that these two documents tell completely different stories. For Buffett, it's all about health versus performance, long-term durability versus a short-term sprint. This right here is the heart of it. The income statement, that's all about performance. It tells you how the company did last quarter or maybe last year. It's like a report card. But, and this is a big but, that story can be, well, let's say dressed up. The balance sheet, on the other hand, tells you about a company's health. It's a snapshot in time of its real underlying financial condition, its true durability, and that is much, much harder to fake. So here's the crucial point. Buffett is looking for the foundation. He wants to see the solid, concrete structure that's holding the whole thing up. He couldn't care less about a great-looking house built on sand. He knows that strong, durable assets and a really conservative capital structure are what actually produce those sustainable profits, not for a year, but for decades. Okay, so what is he actually looking for when he cracks open that balance sheet? It's not some super secret complex formula. It's actually a very disciplined checklist that helps him find what he calls a financial fortress. Let's take a look. And here you have it. It's so simple, it's brilliant. First, the man hates debt. He's looking for companies with very little or even no long-term debt. Why? Because debt can kill you in a downturn. Second, he wants to see that shareholder equity number going up consistently. And third, he wants to see a giant pile of cash and other stuff that can be turned into cash quickly. And let's just quickly touch on shareholder equity. What is it really? The simplest way to think about it is just the company's net worth. And when Buffett sees that number marching steadily upward year after year, it's a huge green flag. It tells him the company isn't just making money, it's taking that money and putting it to work successfully to grow the business from the inside out. That's a sign of incredible management. And this quote just perfectly captures his ironclad discipline on debt. I mean, this is from way back in 1996, which shows you just how fundamental this is for him. He is literally saying he would rather walk away from a great deal than risk the financial strength of his company. That is an incredible commitment to long-term stability over any short-term gain. Now, let's talk about that third thing on his list, cash. You know, for a lot of people, a huge pile of cash sitting on the balance sheet just looks lazy, like it's not being put to work. But for Warren Buffett, that cash is his ultimate strategic weapon. Just look at that number, over $347 billion. That isn't a mistake. That's the result of decades of discipline. It's a frankly staggering amount of financial firepower just sitting there ready to go. So the question is, why? And here's the answer, right from the source. That cash gives him the one thing that is priceless in investing: options. He is never forced to do anything. He can afford to be patient, to wait for years even, until the absolute perfect pitch comes along, an opportunity where he sees a ton of upside with almost no risk. That cash makes him the master of his own destiny. This is what he means by a fortress-like balance sheet. It's not just a shield to defend the company during a recession. It's an offensive weapon that lets Berkshire step up and act boldly when everyone else is terrified and being forced to sell their best assets for pennies on the dollar. It lets them grab those once-in-a-generation opportunities. So, let's pull all of this together. What is the real story here? What's the ultimate lesson that Buffett is trying to teach us with his obsession over the balance sheet? It really comes down to these key ideas. First, focus on the real health of the company. Low debt, lots of cash, growing equity. You gotta remember that a strong balance sheet is the true bedrock of any long-term success. It's what allows a fantastic business to not just survive, but to thrive and compound its value for decades, no matter what the stock market is doing on any given day. So I'll just leave you with this question to think about. The next time you're looking at a business, where are you going to start? Are you going to get sucked in by the exciting story of its recent performance? Are you going to do what Buffett does and start by looking for the quiet, powerful story of its enduring strength?